Anyway, I'm going to introduce our first speaker this morning. He is our host this morning, known, I'm sure, to everybody in this room, and he's the chief executive of an alternative asset management company that's based in London with a very big presence and a very big history here in Dubai and the region. It's regulated by the Financial Conduct Authority. It's listed on the London Stock Exchange. It has assets under management of about $1.1 billion at the moment, and it has deep roots, as I say, covering this region. The chief executive, I'm going to ask you to join him on stage now to welcome him. Give a very warm welcome to our host this morning, Zach Hidari. Morning, Zach. Thanks for being here.
Thank you. Can everyone hear me? Good morning. Welcome. Last week, I was having dinner with some senior people from two of the world's largest global investment banks in London. And if you've been following the news over the last few days in the last week, then it won't take you very long to figure out which banks I'm talking about. And as we were having dinner, I was curious and asked, what's going on? What's happening? We had basically been seeing what you could describe as a bank run for that particular day and the day before. And they all shook their heads and said, we don't know what's happening. It feels like this is how it must have been when Lehman went down. One of the individuals sitting at dinner said, I really thought we were on the Titanic and this was it. We were going to go down and it was game over. So I asked, well, why? What's the reason? Why is this happening? And, literally looked in and said, it's psychology. So Dean was saying earlier, well, we've heard so many reasons why there's volatility. We've heard it's oil. We've heard it's the Fed raising rates. We've heard it's Middle East conflicts. Now we're being told it's psychology. So there is a lot of confusion out there. There is panic. Investors aren't sure what they should be doing right now. And again, I'd refer back to Dean's introduction. Rasmala has been here since 1999, and we believe that gives us some form of perspective in terms of what's happening today. Because in 1999, this DIFC didn't exist. There was nothing here. It was flat land. There were no capital markets as such. It was very much at the beginning. Rasmala was a pioneer at that time. So as a result of that, it is natural that we have seen boom times. We've seen the heyday, which is often driven by psychology. And we have seen some very difficult times. We've seen difficult trading conditions. This is not the first time that we have seen difficult trading conditions. And our strategy, as a result, has evolved and is built around some of the more difficult conditions that we've seen over the years. And I think what I'd really like to say is that there is one key pillar based on which our strategy is built, and that is choice. We believe that in our region, investors are often left with a dearth of opportunity, of investment opportunity, which has an effect on the absorption rate of capital here in the Gulf in particular. So I'm really proud to tell you that 2016 is the 5th consecutive year in which we will introduce new products to the market. 5 consecutive years. So when we went out to the market and we said we would do this in 2011 and 2012, there were a lot of skeptical people in the room. Yes, we've heard that before. It doesn't work. There's not enough scale. There's not enough opportunity. Investors are not interested. It's not liquid. how can Rasmala do this? And we said that's what we're going to set out to do. 5 consecutive years, Sukuk, leasing 1, leasing 2, trade finance, real estate, every single one of them a success. Why? Because investors want choice. That's what they need. So I think the biggest statement for me here today, and the reason why we're all gathered here, is what are we going to do in these difficult times? And one of the most important decisions that we have already taken at Rasmala early this year, having been faced with this barrage of information and negative sentiment, is that 2016 will be another year in which we will launch, because it's not a zero-sum game. In our region, often we find it's either investing or not investing. We believe it's investing a lot or investing quite a bit. So today, we will share with you ideas, discuss ideas, investment ideas that we've been working on that we think should be appealing to investors. But equally important, we want to hear from you what you're seeing on the ground, where you see the opportunity, where you think we can make money, because we have a war chest. We have 5 years of continuous innovation and product development, and there could be an idea that could be generated here today that could be converted into a real product. So please get stuck in. We've got a great lineup. Dean's going to be taking us through the day. Enjoy, engage, and good luck.
I don't think there's a single authority, frankly, on oil prices. Everybody's in a new world. You suddenly have a situation where you have the shale revolution, new technology, horizontal drilling, and you have the US suddenly increasing their production. And combined with the slowdown in China, you have the situation where, of course, oil prices have collapsed. On top of that, you have this geopolitical struggle between the Iranians, the Russians, and the Saudis, and everybody is pumping like there's no tomorrow.
What are the factors shaping the future of the Sukuk market in 2016? Liquidity concerns in the global Sukuk markets are one of the key issues here. We've got a panel discussion with a couple of people here. We're going to welcome Niranjan Kiani of Liquidity Finance in a second. First of all, though, I want to welcome on stage from Rasmala to set the scene just with 3 or 4 minutes to give us some ideas to chew over on this subject. He is the head of fixed income and portfolios at Rasmala. Please join me in welcoming Doug Bitcon. Thanks very much indeed, Doug.
Yeah, thanks, Niranjan, for joining us. 2015, a quick look back on there, it was quite a tricky year. What we saw is issues with the oil price. A lot of people factored in oil prices rising in the second half of 2015. I think that provided a lot of support for the credit markets in the region. I think as we moved into the second half of 2015, there was a realization that, in fact, oil prices weren't going to recover in 2015, and this is a 2016 and probably more 2017 story.
So Niranjan, for you, there are so many issues to consider here. For you, if you pick up on 2 or 3 that you think are really, really important for the Sukuk market in 2016, what are the ones we need to focus on? We'll worry about how those factors play out in a second, but where do we need to train our attention or focus the spotlight?
I think we all are fairly aware of what is going on in the markets at this point of time. In my opinion, the way I look at the Sukuk space, the factors which are going to affect, one obviously is the Fed rate. Second is the Chinese situation or the currencies. And lastly, what is more important, I would say, is that Sukuk markets traditionally have been a lot more resilient as compared to the conventional space. And that is primarily because of the fact that you have investors with sticky money. They don't get in and get out as quickly, and you don't have a lot of international or the hedge fund sort of people who are involved in these kind of, in the Sukuk market.
Since the financial crisis, I think everyone knows, and we have all experienced this, that people and corporates in particular have actually stayed away from the issuance of Sukuk. And to be frank with you, as of now, if we really look at the major issuers and the banks who are arranging all of this, today they're completely busy with selling their own assets in reality. So really the Sukuk market is not really there. I mean, you speak to corporates, you speak to borrowers, they are not interested in the Sukuk. They are really today looking, just get me the finance. I need liquidity.
Just remind us very quickly of those factors, and then move forward over the next 3, 4, 5 years and Basel III, and how that opportunity for alternative houses is going to evolve.
Sure. I mean, is it working?
No. Is Danny's microphone on? Can we turn that up, please?
Hello?
Try now.
Hello? Is that better? Yeah, trade finance has been predominantly dominated by institutional financial institutions. And with the new increase in regulatory requirements, allocation of capital and increased costs, it's created an opportunity for alternative financiers, such as funds, to come in and disintermediate where the banks are now pulling away from. With that in mind, all of the credit-rated entities, the banks are now continuing to finance, but the ones that just fall below that, and now they're exiting or decreasing their facilities.
So if I could turn to you, Jody, what have you seen from the legal perspective? Again, what have you learned over the past few years of this new trend of alternatives getting into the space of trade finance, and how do we take those lessons forward over the next 3, 4, 5 years, and where do you spot the opportunity?
Yeah, well, just carrying on from Doug and Danny, we obviously work with a lot of the banks here, the mainstream banks, and a lot of the questions they have for us around the legal environment are, what is their secured position? Do they have ownership rights? And it's all about how they satisfy their capital requirements. And because of the strict capital requirements on them, they find it quite hard to move into other sectors when it comes to trade finance.
The U.S. right now is deemed to be one of the strongest economies around the world. We've got economic growth, 2-3%. We have a central bank after the financial crisis that is now looking to normalize short-term interest rates. So the U.S. economy is quite far ahead in the curve in terms of its economic potential.
So Deepak, if I can turn to you first of all, you see the general case articulated by Eric, then you see specific case studies like that. How do you convince your customers to invest in this, to write the check? Because people are always skeptical about something new, by definition, alternative investments, but your clients have done that. So how did you overcome that natural skepticism to something new or different and get to the point where they were investing?
Yeah. We've partnered with Rasmala from the very beginning. In fact, our partnership goes back 9 years, and from the inception of the leasing fund, we've been working with Rasmala. Now, there is a reason why this fits in very well with our customer base, because we realize that our customers, maybe a little different from the customer base in the rest of the banks, are predominantly business families, local business families, who've been in the market for years and years, and their primary objective has been threefold, actually. This is what we've realized. One, they like regular income as a preference. So it's not about maximizing your returns. It's about getting regular income for them. If they want to maximize returns, they do it in their own businesses. So these are customers who have flourishing businesses in the market. The second important thing that we've seen in our customer base is that they do not like the volatility of the financial markets. And that is not to do with their risk-taking ability, as we conventionally think as bankers. No, it's not to do with the risk-taking ability. They have immense risk-taking ability, but they do not want to spend their time managing their investments. So when you invest in the financial markets, be it the best equities or bonds or sukuks, you still need to manage them personally and get involved, and there is volatility up and down. This is something that they are averse to. And the third thing that we understood from our customer base, and it's important to understand this, Richard, because that's how the basis of the fundamental of this product attractiveness was built on, and it addresses very specific needs of our customers. So the third key element of our customer needs is to stay asset-backed, Sharia compliant, invest in things that are tangible. So those were the three key elements of our customer requirements.
So Eric, if that's the appetite out there, and the Airbus case study is a great one, and FedEx, and they're great names that will give a lot of comfort to people that Deepak's working with. But maybe that kind of transaction is the low-hanging fruit. That's a kind of in the sweet spot. That's a great deal. As you do more and more of these transactions, do you have to stray away a little bit from the path of what we might call the blue chip or the household names and take a little bit more risk?
Yeah, and of course, there's a range of different lessees that are available at any point in time. What is important to note is that the leasing market in the US is the largest financing market, right? It's bigger than the corporate debt market. And as a result of that, it is an activity which almost all companies are participating in. The CFO at Federal Express has bank debt, they have bonds outstanding, and they do leasing. This is the same with just about any other large corporate who is looking to maximize the financial opportunities they have to finance their business. So we have lessees on our books like McDonald's, like Walgreens, Cargill, Signature Brands, so many of what we would call high-quality corporate credits. And it is something where there is a large amount of opportunities available in the marketplace because so many of these companies, the core business that they have is not managing the equipment that they need to operate their business.
Joseph, if I can turn to you, there's an awful lot of competition for assets like these, isn't there? How do investors through an organization like Rasmala manage to get decent returns when the competition for, I don't know, let's take that telco asset that you bought last year. I mean, how many bidders were there for an asset like that? There must have been an awful lot. So how does that transaction work? From your perspective, first of all, then I'll ask you, Nasir, as well.
Yeah, from our perspective, I guess the UK is a hugely transparent market. There's a lot of deal flow, so it's finding the right asset to start with. But clearly, you can't be thinking you're the only one looking at that. And as you say, there's a lot of depth to the market there. So it depends on how the assets are marketed. Often on an on-market process, there'll be a significant amount of bidders. You're completely accurate. We try and work where we can on a limited market or an off-market basis. But in the UK, it's very rare that anything is truly off-market. There are always a couple of people circling it. There's such transparency and depth to the market generally.
So Nasir, let's take one of those examples, transactions as an example. With such competition for these assets, talk to us through how you filter the deals and settle on a transaction that you want to complete that offers a decent return, that the yield or the return isn't just bid down and down and down to the point where you have to just walk away.
I mean, we see a lot of transaction deal flow, and we do our initial due diligence and then identify as to how much we're prepared to pay at a maximum cap rate. The way we've done it is, I've been in the industry for a number of years now, and a lot of the people that we're buying through are people that I've worked with or know, and it comes down to reputation. It comes down to your network. I mean, the first transaction we managed to buy it because we were introduced to the opportunity before it even came to the market. We got to the asset, we ran our numbers as quickly as we could, and we made him an offer which was pretty competitive, and we managed to secure it. So having said that, I mean, at the end of the day, we've got involved in a number of bidding battles. We haven't been able to secure those assets because there's always a bidder who comes in and makes an offer which just doesn't make sense from an economic perspective. If they want to hold on to it as a long-term asset for their own particular investment scenario, that's fine. But we're not going to get caught up in just overpay.
Well, I think one thing that is important to recognize here is that investors, and when you invest, it's very important that you diversify your investment strategies. And what we've looked to do by developing a much wider choice for investors has allowed them to have the building blocks necessary to build diversified portfolios. Diversified portfolios without heavy concentrations towards one particular asset class, one particular geography, or one particular structure. So when we are working with our clients and with our distribution partners, we're able to use these building blocks as a method to create strategies which are, how should I say, overall unique for the individual clients by weighting different allocations to these underlying strategies. But as we continue to innovate and as we continue to develop more investment strategies, that possibility to diversify is made simpler and simpler for our clients.
And in terms of weighing up the pros and cons of what are in some ways fairly similar asset classes, what are the kind of conversations you have? What are the kind of questions you get asked by the head of a family office, the chief investment officer at a family office, saying, okay, well, you know, all of these things offer me mid to high single digits. They all offer me asset backed. What do I pick, Eric? How do I weigh up the pros and cons? How do you answer questions like that?
Well, I think it gets back to the same fundamentals of diversification. And so we often are working with these clients to allow them to, access multiple products and multiple strategies, which help them to offset any possible, volatility or poor performing products that might come into the future. Because real estate has certain return attributes, trade finance has certain return attributes, leasing has different return attributes. They're in different geographies. There are different underlying returns and risks. And so what we want to do is offer the clients a very broad product set and then assist them in setting the allocation amongst these products.
You know, I'm really dying to ask you, which one's your favorite? Or do you love all your children equally?
Well, for our own investments, I'll tell you, we've got money which sits really within the public equity markets, which are offering investors who have the stomach for high returns, quite a interesting buying opportunity. So alongside all of these stable, conservative, low-risk, steady products, we also have products that are there for clients looking for high teens, low double-digit returns, or high, mid-teens plus. And in the equity markets, with the entry points at this point in time, this is where I think you'll see those high outsized returns come on.
We've got time to take 2 or 3 questions for our panelists right now. So much to digest from this morning. Just before we wrap up, who's got the first question? Yes, please.
Just a quick question. I mean, we had a look at all these different types of investment opportunities and what Rasmala is doing. But with the current market condition, isn't it really the time that we focus on distressed debt, distressed assets, distressed projects as a new product that we can bring in, Islamically structured?
I mean, there's no doubt that during this turbulence, there are situations where distressed companies might yield a very attractive forward-looking return. We tend to focus more on providing a steady return, protecting capital, allowing it to grow at a reasonable rate, but not focused on individual transactions in the distressed area. What we tend to see is most of our clients are not interested in these type of, how should I say, turnaround stories or breakup values. They're more interested in steady returns, regular coupon payments, a surety of capital, irrespective of a turbulent market environment, or let's say a market environment where everything seems to be going very well. And so focusing on our clients and their needs and requirements has been a key component in what we've considered as we've looked to develop these.
Well, I hope you can see that we've been very busy over the last few years, and I hope you've got a chance to learn more about the investment strategies that we've been working on. I think the comment I made this morning is still relevant in that we're looking for ideas from you as well. We are committed to continuing down this journey of expanding our product range and giving our investors as much choice as we can so that they are able to have a broad base of opportunities despite whatever the environment might be. So we look forward to continuing that engagement with you in the weeks and months ahead, and we'll be back here again in the not too distant future, and we hope you'll join us then. So the last final thing is for me to just say thank you. Thank you to the panelists. Thank you to the Rasmala team members who participated today. Thank you to Muna back there, who makes these events come to life. Thank you to Haroon, who's also played an important role. Thank you to all of you for joining us. And last but not least, thank you to Richard Dean, who's given that bit of oomph to the event. That was great, and we hope you'll come and join us again as well at a future event. Thank you very much.